Welcome everyone to the UNEP Finance Initiative Regional Roundtable for Africa and the Middle East. It's a pleasure to have you join us today on this amazing panel. The session we are about to start off is on next steps to financing a green and inclusive recovery in Africa and the Middle East. We all know what time we've been in with the COVID pandemic from early 2020. And this has necessitated action, rallying calls to have a green recovery. Of course, being in the decade of action to 2030, where we are still in line to meet the Paris Agreement goals, of course, with particular shortbacks. And on my panel, we have a great representation of 4 industry leaders who will call upon to talk to us and have a fruitful conversation. Yes, and without further ado, I will invite the first panelist, Amal, to introduce herself. So welcome, Amal.
Thank you very much for that kind introduction. It's a pleasure to be here. As always, we frequently at Bank of Africa over the last 15 years or so, we've always participated at the regional and global roundtables. So my name is Amal Benaissa. I'm Sustainable Finance Manager at Bank of Africa.
Thank you very much, Amal. My next panelist, Nuru.
Hi, thank you so much. It's a pleasure to be here. Thank you, UNEP for the invitation. Again, I'm Nuru Mugambi. I work at the Kenya Bankers Association, responsible for public affairs. I'm one of the directors there, but my focus is on sustainable finance, really just making sure that we're supporting the banking industry to underpin sustainable economic development. One of our key projects has been the Green Bond Program, which has been supported by many partners and is a good example of the importance of collaboration. And I know we're going to be talking more about green finance during this conversation. Thank you.
Thank you very much, Nuru. And next we have Funso.
All right. Hello, everyone. Thank you again to the organizers of this very important conversation. It's a privilege to be here. My name is Olufunso Shomorin. I am with the African Development Bank based in the Eastern African Regional Office in Kenya. I'm the Regional Principal Officer, and I'm in charge of mainstreaming climate change and green growth in all bank policies and operations across 13 countries. But more importantly, the team that I lead is very much interested in improving climate finance access in many of our member countries. But I think this is very much nested within our work on the NDC implementation in member countries. And I think today we'll be talking a lot about what that means as we grow better, as we build better, and as we go through this green recovery. Thank you.
Thank you very much. And next we have Dr. Mahmoud.
Thank you, Ruben. And it's a pleasure to be in this panel. And my name is Dr. Aisha Osman Mahmoud. I'm the special advisor to the governor on sustainable banking with the responsibility of driving the sustainability agenda for the banking and non-banking institutions in Nigeria. Thank you.
Thank you very much. I think we will dive into the discussion immediately just to get more nuanced views on these. So Amal, given the priorities, you've said this is a priority for your bank in Egypt. What do you see as what is the recovery looking like? And what is the green aspect of the recovery?
This is a very, very pertinent topic that you point out, and it's really a pleasure to be here among colleagues that we've interacted with before, the Central Bank of Nigeria, the Kenyan Bankers Association. How for us, it really, despite our vision for the last 15 to 20 years about sustainability and sustainable finance being at the heart of economic and social development, today in a post-COVID-19 reality, it's ever more clear that this is not a luxury. And for us, the key actions taken in favor of such a finance is really based on four main pillars, and I'll get to talk more about that later. We need to blend more finance, which is bringing together more public and private funds. As we all know, in support of the Sustainable Development Goals, the large gap in financing across the board for all Sustainable Development Goals means that the public sector alone cannot fulfill this gap. So, coming from a commercial Pan-African bank, based here in Casablanca, but all across the continent, we have key observations to make that together we can join more forces, blend more finance. Here in Morocco, we've had many success stories about energy efficiency products, water treatment products, really business solutions for SMEs to operate and optimize their functioning and business operations. But we do that with our public partners, our development finance institutions. We're able to bring technical assistance to the clients. We bring them an incentive, so financial incentive plus technical assistance in order to propel a new kind of business on the continent. So our dream is to see this happen in many other parts and to use our success here in Morocco to kind of bring in more partners on this model. For us, the key actions also to be taken are really linked to this blending of finance, which is the new partnerships, new kind of partnerships. Not everyone doing it alone, public sector, the private sector, the organizations, the NGOs. How can we have more forums like these propelled by UNEP-FI? And in fact, we are proud to be the first African signatory of UNEP-FI since 2000. This is a key forum where we can come to debate. And maybe this forum can take us to the next level by helping us to build better and new impactful partnerships. The third pillar that for us is key really to propel this new kind of green finance in a post-COVID-19 reality is around investing in skills and talent that can take what we call ESG to the next level. It cannot be done only with financing or fancy business models. It will be done by the people of this continent that need to reinforce capacity. I know that this word is very large. We say it all the time. We need to build capacity. But really, especially in the Francophone parts of the African continent, how can we have more access to the climate finance, more access to funds? How can we build capacity to become more literate, well-versed in this type of new financing? And finally, this capacity is not only around talent and new skills, but it's also how can we build more capacity to align the objectives of the public and private sectors. We can no longer act in silos. And the pandemic, the crisis in general, is a good opportunity for us to again, like I said in the beginning, join the forces financially, skills-wise, and in a partnership format. I think this is good to start off the discussion, and I will use more concrete examples on the next one. Thank you.
Thanks, Amal. You mentioned a couple of important things. One from blended finance, and to which you alluded to the role of private capital in doing this. Something else that I picked, which is very important, is around providing technical assistance. And lastly is about the alignment, of green finance in terms of, how you just, transition how the capital allocation as a bank. I just want to pick on that, on the elements of, technical assistance and green finance. And Nuru, as you speak, maybe that is something I would want you to speak much about. What are banks in Kenya doing as far as technical assistance goes, and just the alignment of capital allocation to green financing?
Yeah, thank you so much. And it's always great to hear from our colleagues in different countries. I think what COVID has reminded us is that the social dimension of sustainable finance is still very much in play. I think for the past probably 5 years, we've been so focused on the environmental dimension of sustainable finance. Perhaps we have forgotten how interconnected, but particularly from an emerging market perspective, how interconnected our economies are with societal well-being. And it's because our economic structures are so largely informal. So I think we're all learning and relearning this practice of sustainable finance. I definitely agree with Amal that blended finance is emerging as a critical area. In Kenya, for example, if you look at the Acorn transaction, which was our first demonstration green bond, this project was, or the issuance was heavily supported by Garantco. And with that support, it really attracted investors. And then the other aspect that helped the Acorn transaction was lobbying around tax incentives on green bonds. Kenya introduced through the legislative process the first withholding tax incentive for private sector green bond issuances. So those two aspects, again, just reinforces the importance of collaboration, the potential for blended finance. Kenya Bankers Association has been engaging with, maybe I'll speak to one of the projects most recently. It is a blended finance project, KBA together with Kenya Climate Innovation Center and Financial Sector Deepening Kenya. We are working with 4 banks, ABSA, KCB, Sidian Bank, and Standard Chartered, to really investigate and see how can we support entrepreneurs and startups in the green economy to scale up. A lot of these entrepreneurs, obviously because of the perceived risk, obviously are not attracting commercial finance. However, their story is a good story. It's an impact story. We know a lot of impact investors are coming into this market and especially this region. And therefore, perhaps is an over-reliance on grant funding. So we're trying to explore through this project, how do we transition these types of entrepreneurs towards commercial finance, which is a little bit more sustainable. When you think about M-KOPA, for example, that's how they started. They started in the grant space. They were able to scale up to get some commercial finance, and now they're certified under the GCF. So how do we start having more success stories like M-KOPA? And that's what we're trying to investigate. Coming to the climate finance landscape in Kenya, most recently, the national government, through the National Treasury, released the climate finance study. And this was the first study of its kind that really wanted to track where climate investment is going, both from public and private investment. And I think this was a very exciting study. We did it last year. It was supported by KEPSA, the Kenya Private Sector Alliance, Kenya Climate Innovation Center again, and KBA. But the authors of this study was GNI Plus, and they really drove the process. And what we found is 2/3 of climate-aligned investment in Kenya comes from the public sector, both domestic and international, and 1/3 comes from the private sector. And perhaps we need to reverse that. But when you look at the private sector investment, 80% of that is banks. So we recognize the opportunity and potential to support banks. And you talked, Ruben, about capacity building, and that's what we're trying to do. How do we get banks to realize and take a more strategic look at this green economy sector? Banks have been financing agriculture since Kenya was a republic and even before that. So agriculture space, we know. Manufacturing space, we know. Transportation, tourism, we are in this space, but we're probably not looking at it from a green economy, sustainable development perspective. And that's what really we're trying to touch on as an industry. Thank you.
Thank you so much, Nuru. I want to come to you, Fonso, and just piggyback on what Nuru said. One is around, I picked the issue of incentives with withholding tax incentive that she mentioned. And I know AFDB is very ambitious, as a regional development bank, to, go to 40% plus of, all your capital going to green finance. What is the incentive structure looking like? Of course, as you speak about, other things regarding this topic, maybe that is something you also want to, start us off on, what incentives are looking like from a Pan-African perspective.
Well, thank you. Thank you very much, Ruben. And indeed, thanks Amal and Nuru for, setting the scene pretty well. And I think it's very important to be able to merge these two ideas together, one from the commercial bank perspective, but also from an industry perspective, to see how they really build a case around green recovery. Now, I'm going to come back to the question you asked, Ruben, but I think first and foremost, it's very important for us to be able to unpack the concept of recovery. What is the goal? What exactly do we want to achieve? You know, we're dealing with two crises at the same time, and these crises are quite huge. We're talking of 20 lost development over the years, depression in 25 years, economic downturn, and increasingly we're also beginning to see that, well, while the economic focus in many national systems are very important, we're also seeing that we can't ignore the social systems, and perhaps we have ignored the social systems for the longest time, and this is what COVID is actually bringing to our attention. And thanks, Nuru, for raising that. But I also want us to understand that the moment we are able to anticipate what is a green recovery, what does it look like? What picture would that be? Then that helps us to be able to begin to interrogate the interventions that we are having today. So from the bank's perspective, I like to say that we keep hearing things like we need huge investment in energy, in water, in agriculture, and these are not new. They've been there before even COVID. What is happening now is we are talking about more than ever the need to embrace resilience with another thinking, because we're talking of dual resiliency, one against climate change, the other one is against COVID, and I think they're quite related. The opportunity that we have is, as we relate to our economic and social resilience against COVID, can we do that in a way that also helps us to achieve our climate action goals? And in the same vein, as we begin to build our resilience against climate action, can we also do that in a way that we build the capacity to be able to address or respond better to future pandemic? So that interaction is very important, and we need to be able to look at it. So when we build a road, we don't just look at a road for the sake of vehicles passing on that road. We have to build it with a renewed mindset that can this be a connector to agricultural landscapes? Can this be an opportunity to improve trade? Can we have more women, in economic spaces? Can we have access to ungoverned spaces? And I think that, for me, is the biggest part of this conversation. And so we come down to what the bank is doing. I could bombard you with numbers, in terms of what we're doing, but I think it's important to make sense of those numbers. I would say, first and foremost, we need more capital investment in adaptation-related projects. Adaptation will have more in helping us to reach recovery more than anything. And it's very important that as we look at climate actions, we're very focused around adaptation type of projects. And unfortunately, we're not doing very well. So I want to give an example to the report, the climate finance report that Nuru mentioned. In Kenya, we're talking of 79% going to mitigation. And so we need to change that. So what the bank has done over the last few years was, first and foremost, on our climate finance, part of our own resources, we've been able to move from 9% of climate finance in terms of our total lending in 2016 to 36% in 2019. So 4 times increase in 3 years. And our goal is actually to reach 40%. So let me put it in a context. On average, the bank approves about $10 billion worth of investment every year. So 40% of that, that's about $4 billion, will be going to activities on the ground that are consistent with either adaptation or mitigation. Now, the bank is very big on adaptation. And I'll tell you, in that same 2016, only 26% of our lending went to adaptation. By 2019, we had moved to 55%. And compared to other MDBs, this is quite impressive, because adaptation will continuously be a priority for Africa. But we must see mitigation as an opportunity, and that opportunity is to push the priority of adaptation. So it's very important that we don't even look at this investment from the bank side as everything that is needed. Rather, we look at it as a catalyst in leveraging additional resources. So we're beginning to look at what are the ways of using that investment to attract private financing, and either in form of instruments such as guarantees, in terms of, whether partial risk guarantees or partial credit guarantees. And that is what is needed. And again, I want to join my colleagues in saying public finance has been good so far, but that is not the future. Rather, public finance should be the space or that provides incentive for private investment. So then the question is, how do we, in very deliberate terms, catalyze this private investment? First, it's very important to continuously support the work that many government officials are doing in terms of providing the enabling environment. Policy incentives are very important. The ability to provide that assurance to private investors to say, listen, in the event of a contractual, obligations not being met by a government official, we will provide the guarantee that you need. That is very important. But also, we also need to help our government and the public sector to do this thing we call investable projects. And I'm really tired of talking about it, bankable proposals and all of that, but we will never stop talking about it. There's a level of capacity that we need. We have case studies of good practices in many countries, particularly in East Africa. But as Amar said as well, when you move to Francophone Africa, it's a complete story. So how do we build that, best practices in some of the countries within the continent and move that to other countries within the same continent? And I think it's very important. I'm going to keep it here for now, but I'm sure we'll come back to some of these points. Thank you.
Thank you very much, Funso, and I'm going to build on that later. But first, let's move on to Dr. Mahmoud. And I think, Dr. Mahmoud, with what we've had from, like a private finance perspective from Amal and from Nuru, and Funso having given us the perspective from regional development bank point of view, would be nice to hear, what does this sustainable finance look like from a central banking perspective, and how do you see regulators playing a catalyst role in the green recovery process? And of course, you can give us case studies from Nigeria. Welcome.
Okay, thank you very much. And just building on what Funsho has said, in understanding what green recovery means, we also need to know that although that is the buzzword, globally, UNEP in 2021 has said that despite the economic repercussions and all the other vulnerabilities that the pandemic has impacted on countries, we've missed the opportunity, so far for green investment. And this is because only 18% of the recovery spending that have been committed by countries are considered green so far. So, and within the African region, I think there is growing momentum for green recovery, because our ministers of environment also met in 2021 under the AMSEN and committed also to moving the continent, through an effective recovery, green recovery from the COVID-19 pandemic. So for us in Central Bank of Nigeria, we have a stimulus package, that is robust and is to assist the Nigerian government in achieving its recovery post-pandemic. And this includes investment in infrastructure. We've issued the green infrastructure bond, and then mobilization of capital flows through green bond issuance, and also the movement of the issuance of targeted facilities, to assist households and businesses, women in particular. As we said, as the previous speakers have said, we have missed the social priorities that we need to impact, but the COVID is making us to realize that now. So a lot of is happening within the stimulus package. for the Central Bank of Nigeria. But when it comes to sustainable finance, we are acting as catalysts both for the whole financial ecosystem by ensuring that we implement some frameworks, environmental and social risks framework, like the sustainable banking principles for the banking institutions, and then the Nigerian sustainable finance principle for the non-banking institutions. And as a result of this, the banks are ensuring that they now reduce their lending for carbon-related projects, carbon-intensive projects. And for the non-banking institutions like the Security Exchange, the Nigerian Stock Exchange, the pension industry, a lot is happening to ensure that investment also are aligned with the with sustainable finance and then green finance. And some of these I will say in details when the time comes. But I just want to tell us that for us to prioritize, green recovery, it is important that we imbibe technologies, increase digitalization, infrastructure, renewable energy, nature-based solutions. I think these are key for the continent. And then lastly, I think also we need to ensure trade. So the implementation of the African Continental Free Trade Agreement will offer an opportunity to grow green and build sustainable trade within the continent. Thank you.
Thank you very much, Dr. Mahmoud. And I think from the round that we've just had, we've been able to very efficiently combine part one and part two of this session, because we've tackled about what green recovery is going to look like, but also so you've helped us to understand context. I think more like topography, like what do we actually mean by green recovery. And of course, in the historical context, Africa experiencing the first downturn in the last 25 years, which I think is great to know where we are coming from. And Nuru, to which you added, and Dr. Mahmoud has echoed, we've ignored the S in the ESG. It's always been environment, but now with COVID, it's just highlighted the social aspect. And some of the things I've had, because I want us to do a final round, just for the sake of our audience. So some of the things we are hearing in terms of challenges, so far as I've mentioned, is we've neglected the social aspect of ESG for a very long time. We've heard about issues of capacity and capacity building. What is lacking, and which has Amal mentioned, and Funso, you've reiterated on that. Then something that has been highlighted, we've had an over reliance on public finance, and we are saying, for us to be able to achieve their alignment to climate action goals for countries to meet their nationally determined contributions, we need to see more momentum coming from private finance. Something else that has been mentioned is, in terms of timing, Dr. Mahmoud has said we may have, missed some opportunity that was actually there. And and in terms of things proposed, and I think this is what I'm gonna build up on. So the overall things I'm hearing what needs to be done. One is blended finance. We talked about partnerships, and this includes, working together with DFIs. I've heard about technical assistance. We've heard about alignment to green finance, incentives like the incentive that Nuru mentioned. We are hearing about having, relatable case studies like M-Copper. Funso, you've mentioned about aligning finance to climate action goals. Something else I've heard is, just having some proper captive investment in adaptive related projects, so that, for example, Kenya, we move from 79% mitigation and just, pivot more towards adaptation. Then there's a case of investable projects, which you mentioned. Dr. Mahmoud has mentioned about building investment infrastructure more. And also, she's brought in three very interesting things. One is around tech. then having nature-based solutions, and also the issue of trade. As we wind up, because I see we have 12 minutes and I want to give each of you around 3 to 4 minutes up, I just want to know from a practical perspective in terms of next steps, what does each of you want to see? What is one or two things that you want to see and you think, in your capacity, be it commercial bank or banking association, regional development bank or regional bank, what is this one thing you want to see? So 3 minutes on what is the one thing you want to see going forward. I'll start with you, Amal.
You ask us $1 million question. The one thing, there are indeed many things, but if we had to hone down on one aspect, it would really be around building capacity for Africa. And I mean, when I mentioned the issue of talent and data gaps earlier, and our bank is by the way very active on many initiatives, including the Sustainable Data Alliance, where we try to think how can we fill those gaps, is because already there's a gap on the continent of what it means. What does sustainable finance mean? What is a project? What kind of taxonomy? This is happening at the EU level, at the world level, but in our continent, the concept of additionality, of when a project is deemed sustainable or green, is not really well defined. It's not just about renewable energy. It's not just about energy efficiency. So we need more capacity to really train our bankers, because coming again from a commercial Pan-African bank, is what kind of DFIs, maybe the African Development Bank, maybe with the Bankers Associations or UNEP, how can we build more capacity around already understanding what are we talking about in order to channel the funds into that? So that's very, very important. Our bank is very active on that. We've actually sowed many partnerships post-COVID-19. We just finished a big training program in partnership with Finance in Motion, across our African subsidiaries, where we first of all discussed ENS risks. We did another one this year post-COVID-19 with IFC to teach our commercial folks what is climate finance in very basic terms. And linked to the capacity are really trying to help us have better tools. The banker will never be a climate scientist. We don't expect the banker to be an expert in a post-COVID-19. That's too much pressure. The banker is here to sell financial services. And for example, with IFC, we are now using this tool called CAFI, Climate Assessment in Financial Institutions. These are the kind of tools that are online, easy to use, quick, 5-10 minutes. The banker feels confident that we can track and align our portfolios with the goals that we want. It helps at the governance level, the board track different targets. It helps the banker feel that like they're channeling finance to the right projects. So for me, I know it's one, if I had to choose one, obviously there's many other issues, but this would be for me the heart for our continent. Build capacity around the data and also trying to find the right tools that are pragmatic. Thank you.
Thank you very much. So build capacity around data, talent, tools, and with the outcome being to be able to reorient more capacity towards financing this kind of work. So thank you very much, Amal. Nuru, what is one thing you would like to see from where you sit?
It's such a hard question, but I'll try to be very quick. I think on the government side, I'd like to see government continue across the continent, because I really want to recognize all our countries, including Dr. Mahmoud, doing amazing work. Even the Bank of Morocco is also doing great. But that's to say, I'd like to see governments supporting more on the analysis aspect. There's a great case study on the government of Tanzania and just looking and analyzing the national Serengeti Park infrastructure around that and just analyzing that project. They were able to make a decision on where to invest and how to design that infrastructure to create the most socioeconomic impact. So I think governments have a key role to leverage data and analysis to help bring in investors by helping provide the data points in terms of how their investment is helping to reinforce socioeconomic impacts. On the private sector side, it touches on public as well, but on the private sector side, what I'd like to see is DFIs really, and Dr. Alfonso, DFIs, I think AFDB is fine, but DFIs really looking at, there's this tension around scale versus impact. I think most DFIs want the big transactions. That's why you see a lot of capital is going to energy, because they want to deploy their capital quickly and show their proof point. But the impact is in the small businesses, these small companies with turnover of $30,000 a year, and there are millions of these customers that are looking for capital. So I think we really need to reframe this whole issue of what impact is. It's not that 1 or 2 wind farm projects. Yes, we need the supply of energy, but we really need to look at supporting some of those smaller transactions. And that's where digital comes in, what Dr. Mahmoud was saying. I think we need to leverage on technology to see how we can efficiently deploy capital. Thank you.
Thank you, Nuru, and thanks for hearing your rallying call around government. I know we have people from government listening in on this, and secondly is your challenge towards private sector, and I think that's a very good dimension you bring between, the tension is happening between impact and scale, and of course point for another day discussion is just how to support local small scale incentives, which may not have the attraction of huge capital, but have very high potential for impact. So thank you very much for that. Funso, what is one thing you want to see?
All right, thank you. It's really hard to say one thing because there are many things that we would like to see. But in addition to the points that have been raised by my colleagues, and brilliant points, by the way, thank you very much. I think I've been asking myself a question. What are the factors behind the success in the mitigation space? Take, for instance, energy. And please, I want everyone in the audience to probably go look for the document, the Climate Finance Landscape for Kenya. I think it's something we should do for all countries, and it can really help us to deepen our knowledge about a number of things, particularly around flows, financial flows. And there are going to be a lot of reasons behind the success, and probably energy, for instance. Some of them will be around issues of private capital investment because there's an enabling environment, but also there are policy incentives or the likes. And then the question is, can we transfer those lessons for adaptation? Are there good things happening in the mitigation space that we can build on for adaptation? And particularly, how do we create a policy incentive for private capital flows for adaptation projects? How do we make adaptation go beyond the public good type of investment and see the value in private investment? And that is something that's very important. I don't think we have an answer to that, but it's a question that is really coming to our attention over and over again. So if you're out there, if you have the perfect solution, please reach out to us. We'll be happy to onboard you as a consultant to do the work for us at the bank. But beyond that, I want us to just step out of this conversation as either an individual, as an institution. I want us to look at what we call finance or money. I think from my own multiple years of experience in this work, I've come to, particular terms that money or finance, whatever name you call it, moves in three directions. And this is very important. The first direction is money moves in the direction of what I call solvable problem. If there's a problem out there that can be solved, low energy assets, food insecurity, whatever it is, the chances are that money may possibly move in that direction. The second part is money moves in the direction of capacity. And I think we're going to keep saying this: institutional capacity at national level, management capacity, technical capacity, the ability. You hear things in our industry like the people who have money claim they cannot find bankable projects. And the people who have bankable projects tell you they can't find money. And these are people existing in the same space, in the same environment, in the same ecosystem. And you have to say, what is bankable? But those are languages of capacity, and I think it's very important. Last point, money moves in the direction of relationship. More than ever, we must continuously put attention to strategic relationship. Strategic relationship between public and private, but also strategic relationship between local and international, strategic relationship between state and non-state. And we must be able to see that to the best of mobilizing financial resources for all the investment. I'm going to keep here for now, but again, there are too many things we want to see, Ruben, and I'm hoping that we can take them one day at a time. Thank you.
Thank you very much, and that's really brilliant. And I think one thing I wanna reiterate that you mentioned is just being able to see the investments that go to adaptation and mitigation beyond the aspect of being a public good. People care about return on investment and this kind of thing within this sector. So we need to say how do we see this as actually viable investments beyond the idea of a public good. And thanks for highlighting the three directions in which money moves. And I will be sure to quote you on that, Funso, on some other session. So Dr. Mahmoud, what is the one thing you want to see? And I think this will be a great way to close up the session, to know what you want to see from a regulatory, hawk-eyed perspective.
Okay, thank you very much. Just like the other panelists have said, it is difficult to just zoom it just to one thing, but I'll try as much as possible. I think the right policies, right programs, right projects, are central to this green recovery. But then the mobilization of capital. So we need the right policies, right program, right project to mobilize capital. And
sorry, you went on mute.
Sorry. So for the African continent, when we align these policies, programs, and projects together, we have the opportunity, through regional cooperation. And what is happening right now with the boom on green bond within the continent, we could use that to mobilize for the capital that is needed for green recovery. But also there is something I want to mention. We know the recovery efforts for the most African countries is hampered by servicing debt. African Development Bank, they need us to pay the monies, that. So World Bank and all these things. So I think we need to also ensure that there is acceleration of debt relief, within the continent, so that we could be able to channel these funds, for green recovery instead of having to service debt, with them in addition to that. And lastly, I think for me as coming from the regulatory side, I think the right regulation, robust regulation, and then supervisory frameworks, are also key to this. And given the right incentives, tax relief, as has been mentioned by some of the other panelists, to ensure that we mobilize capital and for the green recovery. Thank you.
Thank you very much, Dr. Mahmoud. And yeah, I would echo that. And I think largely what you've spoken about, whether be it policies or the regulatory framework, I think that's very important because we all know there's a commitment of $100 billion every year to developing countries to support alignment to Paris Agreement. And I do know most of this investment coming in, one thing that investors are very keen on is the tax environment, the regulatory environment, predictability. If it's investment, they want to see some very specific sunset clauses and provisions for that. So I do agree a regulatory environment is very good as an enabler on this. Two things I just want to echo again that we've had from this discussion. It was mentioned about being able to codify what success factors look like, and I want to invite the audience to look for the report on climate finance landscape in Kenya. As has been overly mentioned, it's a very good report in terms of highlighting what the landscape of climate finance in Kenya has looked like. And within that report, something that would be nice to also have a look, it highlights, from a sectoral perspective, what is the amount of money needed to meet like NDC targets for Kenya, and how much is actually flowing in, and looking at the gap. And it's just incredible to see that, some of the sectors that are going to play a very big role as far as adaptation goes have some of the biggest gaps in terms of financing, which means that needs to be closed. And of course, Funso, to your 3 points, those are solvable problems where money can actually flow. And so the question becomes, how do you actually build capacity to attract that kind of capital? And Amal, this goes to your point, largely around, how do you build capacity around talent? How do you build capacity around data? Because data has been a big issue on the continent for years. And how do you build also, institutional capacity in terms of, governance structure, management talent, and all that. And so, of course, we cannot exhaust all the discussion today, but this has been really amazing. And for the next session that is gonna be coming up after this, we are gonna be looking at insurance, because if we are gonna invest money into adaptation, then a key point of adaptation is, say, we are already faced by the risk of, natural disaster and calamities. Then the question is, how do we build capacity on the insurance side? And our next session will be looking at, how do we harness insurance for the achievement of the Sustainable Development Goals, something we've developed within UNEP we are calling ISDGs, insurance for SDGs, and just seeing how can we get more people to take up insurance, even innovative means, whether it's insurance for ag tech, whether it's insurance in the healthcare space, and use insurance to be able to build a resilience across the continent, even as we look forward to green recovery. So lately, ladies and gentlemen, it's been a pleasure to have you on this panel. And thank you so much for your contribution. And thank you to everyone in the audience who've been able to join us for this discussion. Thank you very much, and enjoy your day.
Thank you so
you.
much.
Very much.
Thank you. Bye-bye.
Thank you, everyone. Bye.